Fundamental analysis versus technical analysis. This is usually a very debated topic. So which one should you use? Hi, I'm Alvin. I'm the founder of Dr. Wealth. Today I'm going to discuss with you the differences between fundamental analysis and technical analysis, and also their limits to each of the approaches. But let's first define what do we mean by fundamental analysis, okay? And fundamental analysis, most of the investors use things like financial statements, or it can even be like economic indicators to gather some sensing on the value of a particular investment. So there's this belief that price is not always equivalent to the value of the investment. So which means if the price is below the value of the investment, it becomes generally a good buy for them. So that is the primary belief of fundamental analysis. All right? And now let's define technical analysis. So what most people understand it from is that they usually derive information, buy and sell signals from the charts itself. And the charts, of course, is a representation of the stock prices movement over time. And it can be other technical indicators as derivation of price or even volume data. And that's how they make certain decision on whether a stock is going to be bought or sold. And the primary belief of technical analysis is that price is reflecting all the information that's available. So whether there are some changes in the fundamental of the business, etc., technical traders believe that the information has already been priced in. So you can see there's a fundamental difference in the belief themselves. And that's why these two camps are very different from their approaches, and they can't really agree with one another. Let's now talk about the limits of fundamental analysis. So the belief is that value is very important. To determine the value of the business, for example, they have to look at the financial statements and things like that. But sometimes the information that's provided may not be 100% accurate. So for example, even in SGX in Singapore, listed companies, they are in the past, for example, the PRC managed companies listed in Singapore, we call them S-chips. They have many incidents of reporting false numbers, and that misled investors to think that there's a lot of value in the company, but actually it's all made up. So when the information is false, fundamental analysis breaks down. It is actually acting on a false information to provide certain valuation technique. So that is the key issues of fundamental analysis. And the second thing is that when it is undervalued, right? Let's say a stock is worth $2 and the price now is $1, so obviously it's undervalued. But if it goes to 80 cents, it's still undervalued. If it goes to 60 cents, it's still undervalued, right? So for fundamental analysis, the other problem is there isn't a very precise entry and exit for all these positions. So it gives you a very wide range, and that makes some investors uncomfortable because they are not sure what to do at a particular point in time. Okay, that's it. Technical analysis also have their limitation. So as the core belief is that price reflects all information, but that is only true if there is enough transactions to validate the stock prices. So for example, if there are very low volume or lowly transacted stocks in the market, technical analysis doesn't really work because the prices are only determined by one or two buyers and sellers. They are not enough to validate the prices. The price discovery is very weak in that sense. So which means then the belief breaks down because the price is not reflecting enough opinions of the market participants. And the second thing is that for technical analysis, usually it's difficult to manage large capital because technical analysis usually requires agility, nimbleness to go in and out of the market. And having too large a capital slows down the agility, and it becomes very stressful for the trader to want to take out position or take up position, and end up might be moving the markets. So given that, on the contrary, you can see that those limitations of technical analysis is actually the benefit for fundamental analysis and vice versa. I just give you one example, right? If let's say the information is false, whatever, but there are insiders who know that the company may not be doing as well, they may have already been reflected in the stock price. They may not be trading at very good prices or don't have very good price trends. And precise entry and exit that doesn't exist in fundamental analysis actually exists in technical analysis. And managing large capital is difficult for technical analysis because they need precise entry and exit. On the other hand, fundamental analysis becomes an advantage because investors can take a long time, a long horizon to add up position or get out of position. So, ladies and gentlemen, these are the core differences. And personally, if you ask me, I'm more on the FA side, more on the fundamental analysis side. because I find it easier to make money, and I've also seen more successful fundamental analysis investors than technical analysis traders. And some of you might be thinking, why not just combine both together? So you can do that, but provided that it doesn't lead you to more paralysis by over-analysis, because sometimes you may have mixed signals, and what do you do about them? So that's it for today. I hope that you have found your edge in the market, be it whether is it fundamental analysis or technical analysis. So I'll see you next time.